Is the housing market about to crash in 2026? Like a full-on 2008 style home values falling off of a cliff crash? I get this question probably more than any other question I get right now. And honestly, I get it. You open your phone and all you see are headlines about foreclosures, home values, and suddenly you're wondering if you should just cancel the home search entirely and hide your money under the mattress. So here's what we're going to do. I'm going to walk you through the actual real-life data, not the clickbait. And by the end of this, you're going to know exactly what's happening and why it's happening and what to do about it, whether you're buying, selling, or just watching the market. A quick note, if this topic matters to you and you want help figuring out your specific scenario, there's a link in the description where you can click here for a free strategy call. Do that. So let's start with the big one, okay? A housing crash is a steep, rapid decline in home values. We're talking 20% or more across the board. The last one was 2008, where the Case-Shiller index dropped over 25%. That's not a dip. That's a quarter of your home's value gone. A correction, on the other hand, is a slower, smaller decline, up to about 10%. Think of a crash like your car going off a bridge. A correction is more like really hitting a speed bump really hard, a little faster than you really should, and you're like, you know what? I think I might need to get that looked at. You know what I'm saying? So very different experiences. So which one are we looking at right now? Well, neither. Actually, okay, let me back up. There are some soft spots, and I'll get to those in a second. But the national picture, it's what experts are calling a reset, not a crash. There's a really important reason why that distinction matters for your money. I'll explain the number one reason a crash is basically off the table in just a few minutes. But first, let me explain the three things you should be watching. Number one, supply. This is the biggest factor in whether home prices go up or down. It's honestly pretty simple. If there are way more houses for sale than there are buyers, prices drop. If there aren't enough houses, prices hold or go up. Right now, as early as 2026, we're sitting on about 3.7 months of housing supply. That means that if nobody listed another home starting today, it would take roughly 3.7 months to sell everything that's currently on the market. Here's a rule of thumb. Write this down. 6 months of supply is considered a balanced market, not favoring buyers or sellers. Before the 2008 crash, supply ballooned to 13 months. That is more than double what balance looked like. We're right now at about 3.7. We're not even at normal, let alone overbuilt. Now, inventory is going up. It's up about 10% year over year nationally, which is healthy. And some Sunbelt markets, like parts of Florida, Texas, and Arizona, have actually climbed back above their pre-pandemic 2019 inventory levels. So if you're in one of those areas, yeah, you've got more room to negotiate, and you might see some price softening. Even with that growth, we're still about 18% below where we were in January of 2019. And new listings, we're running about 50,000 new listings per week right now. So during the actual crash years, that number was 250 to 400,000 per week. So those aren't even in the same zip code. So here's your test. I want you to pull up your local market on Zillow or Realtor.com. Look at the months of supply. If it's under 4 months, you still have a market where sellers have leverage. If it's between 4 and 6, things are balancing out. If it's above 6, buyers are starting to call the shots. That one number tells you more about your local market than any national headline. Number two, who's actually in these homes right now? And this is where it gets pretty interesting. And this is the most important piece that a lot of people miss. I had someone message me last week, genuinely worried because they saw a headline about rising foreclosures. And look, foreclosures are ticking up. Let me be really clear. There are about 36,700 foreclosure filings in 1 month in late of 2025. That's a 19% increase from the year before. That sounds scary, right? In 2008, we had 3.1 million foreclosures. We are nowhere remotely close to that universe. The overall delinquency rate right now, which means the percentage of homeowners who are behind on their mortgage by at least one payment, is around 4.26%. During the peak of the 2008 crisis, it hit almost 12%. The actual foreclosure start rate has held pretty steady. That means almost nobody's actually losing their home. Why? Because the average homeowner right now is sitting on just under $300,000 in home equity. If you're behind on payments and you've got that kind of equity, you don't get foreclosed on, you just sell. You walk away with the money in your pocket. That's the exact opposite of 2008, when people owed more than their homes were worth, and they just mailed the keys back to the bank. If you want help applying what you're learning here, by the way, to your specific situation, remember, click here for a free strategy call. The link is literally right below this video. All right, so here's where it all clicks together. This is the part I've been building to. The number one reason a 2008 style crash is essentially off the table, and honestly, this is the thing that should let you sleep at night. Lending standards in the mid-2000s. Lending was basically the Wild West. The Mortgage Credit Availability Index, which measures how easy it is to get a loan, was over 850 right before the crash. Banks were handing out mortgages to anyone who could fog a mirror. No income verification, no real documentation, adjustable rates that reset and blew up people's payments overnight. And when those loans went bad, a tsunami of foreclosures hit a market that was already drowning in supply. Today, that index has been under 100 for years, and it's dramatically harder to get a mortgage now. You need real income documentation. You need a real credit history. Lenders actually verify that you can afford the payment. So the pool of homeowners right now is fundamentally different. Most of them have strong credit, real equity, and locked in low rates from the past few years. They're not the same borrowers who were in trouble in 2008. And that's not just my opinion. That is the math. A crash needs forced selling on a massive scale. Forced selling needs people who can't make their payments and have no equity and have no options. That combination barely exists right now. So what is happening? Think of it less like a crash and more like a market that finally took a breath after running a sprint for 5 years. Prices aren't skyrocketing anymore. Depending on who you ask, JP Morgan, Zillow, Redfin, National Association of Realtors, home prices nationally are expected to move somewhere flat and maybe 4% growth in 26. That's not a crash. That's not even a correction. That's just the market getting back to normal speed. And actually, you know what? Let me tell you something encouraging. For the first time in years, wages are growing faster than home prices are. Read that back real quick. Income is outpacing home price growth. That means affordability is slowly, gradually getting better. Not because prices are crashing, but because paychecks are slowly catching up. Now, I got to be straight with you. There are some genuine wildcards in 2026. There have been geopolitical events that have pushed mortgage rates back up into the low to mid sixes after briefly dipping below 6% earlier this year. That erased some affordability gains. And there's been some softening in the job market that's worth watching. If employment spikes significantly, that would change the equation because people who lose their income can't pay their mortgages. But right now, unemployment is hovering around 4.4%, which is elevated compared to a couple years ago, but not recessionary territory. So here's a simple framework. If unemployment stays below 6% and inventory stays below 6 months of supply in your market, the crash math just doesn't work. Those are your two numbers to watch. Check them every quarter. If both stay in range, you're dealing with a slow, normal market, not a crisis. Let me ask you something. Are you waiting for a crash to buy? Because here's what that strategy actually looks like when you run the numbers. Let's say you wait 2 years hoping for a 10% price drop. And let's say you're looking at a house that's worth $400,000 today. If prices go up just 2% a year, which is below what most forecasts are predicting, by the way, that house is now $416,000 in 2 years. You didn't save money. You spent more. And you also lost 2 years of building equity and 2 years of mortgage paydown. Even if prices do dip in some markets, waiting costs you in ways that aren't always obvious. A client of mine, and this is honestly a perfect example, sat on the sidelines through most of 2024 waiting for rates to drop and prices to fall. They finally bought in early 2026, and the house they wanted was $30,000 more expensive than it was when they first looked at it. They still got a great home, and they're still going to be fine, but they told me, man, I wish I just pulled the trigger when I was ready. We've seen this before. We know how it ends. If you can afford the payment today, you buy the house. You refinance it later if rates improve. You build equity from day one. Don't let one headline make your buying decision for you. So here's what to do right now. Step one, check your local inventory. Go on Zillow, Realtor.com, look at your city and find the months of supply number. Under 4, still competitive. Between 4 and 6, you've got room to breathe. Over 6, you've got negotiating power. Write that number down. Step 2, check your debt to income ratio, which is just your total monthly debt divided by your gross monthly income. If that number is under 50%, you're in the qualifying zone for most mortgages. If it's under 36%, you're in great shape. You can calculate this in about 90 seconds with a calculator. Step 3, if both of these look solid, Stop reading headlines and start having real conversations with a mortgage professional who can run your actual real numbers. Because your situation is not a national statistic. Your situation is your numbers in your market on your timeline. And that is what matters. So if this helped you see your situation differently, I want you to do two things. One, click here for a free strategy call using the link in the description and hit that subscribe button so you don't miss what's coming next. I break this stuff down every single week so you can make smart moves with real information instead of reacting to just whatever panic headline pops up in your feed. I'll see you on the next one.